Are you looking at the gold chart holding steady at $4,720 and breathing a sigh of relief because the price isn't crashing? Think again. Unfortunately, that is exactly when the most dangerous trap is tightening its grip on your wallet. It's not the sudden drops you should fear, it's the silence of the market. This stagnation is a psychological predator quietly eroding your wealth and stealing your time, hour by hour. But why is standing still more lethal than a crash? Let's find out. To understand why this $4,720 price level is a trap, we need to look deep into our own brains before we even glance at the charts. Think about it. Why does a 5% sudden crash feel easier to handle than a market that does absolutely nothing for 3 months? It sounds counterintuitive, right? But in the world of professional trading and behavioral psychology, there is a phenomenon known as psychological torture by silence. When the market crashes, you have clarity, you feel the pain, you see the red, and your brain triggers a fight or flight response. You either sell and cut your losses, or you double down. Either way, an action is taken, the loop is closed. But when gold sits at $4,720 and silver hovers stubbornly below $75, day after day, week after week, your brain enters a dangerous state of high alert stagnation. Psychologists call this cognitive dissonance. You bought gold because you expected a breakout. You see the geopolitical tension, you see the inflation. Everything tells you the price should be $5,000, but the screen says $4,720, again and again. This silence isn't peaceful, it's a vacuum. It creates a specific type of anxiety that bleeds you dry, not of money initially, but of conviction. In a sideways market, the pain of waiting eventually exceeds the fear of losing. This is where most retail investors make their biggest mistakes. They start to get itchy fingers. Because nothing is happening, they feel they must do something. They start over-leveraging, switching to risky altcoins, or selling their solid gold positions right before the actual move happens, just because they couldn't stand the silence anymore. The market makers know this. They know that if they can keep the price in a tight range, like this $4,720 box, they can shake out the weak hands through sheer boredom. It's a war of attrition. You aren't being outsmarted by a computer. You are being outweighted by a system that doesn't have a pulse. Look at the volume on the MCX or the COMEX right now. It's thinning. Why? Because the smart money is sitting back, watching the impatient money burn itself out. This sideways movement is a filter. It separates the disciplined from the gamblers. In behavioral finance, we talk about the action bias. Our ancestors survived because they reacted quickly to predators. But in a sideways market, that same survival instinct is your worst enemy. It forces you to move when you should stand still. It convinces you that $4,720 is a failure, when in reality, it's just a pause. But here's the twist. While you are focused on the price not moving, something else is moving very rapidly behind the scenes. Your capital is being devalued by time itself. But wait, if you think just holding is enough to break even, you've forgotten about a hidden thief standing right behind you, a thief called opportunity cost. Most retail investors make a fatal mathematical error. They look at their portfolio, see gold at $4,720, and think, well, I haven't sold, so I haven't lost anything. That is a dangerous illusion. In the world of high finance, a stagnant asset is a dying asset. Let's do the real math that the banks don't want you to focus on. While gold is struggling for momentum at $4,720, the rest of the world isn't standing still. Inflation, the real, boots-on-the-ground inflation, is constantly eating away at the purchasing power of every dollar tied up in that gold bar. If inflation is running at even 5 or 6% annually, and your gold price stays flat for 6 months, you haven't broken even, you're down. You've effectively lost nearly 3% of your wealth without the price even moving an inch. But it gets worse. Think about where that money could have been.
While you were waiting for a Minsky moment or a breakout that hasn't arrived, what did you miss? In the last 6 months, while gold was trading sideways to lower on the MCX, the S&P 500 might have climbed 8%. High-yield savings accounts or treasury bonds are offering 4 to 5% guaranteed returns. This is the shadow loss. If you have $100,000 locked in gold at $4,720 and it stays there for half a year, and during that same time a boring index fund goes up 7%, you didn't just stay flat, you essentially paid a $7,000 penalty for the privilege of waiting. That is the true cost of the trap. The market thrives on this liquidity freeze. When your capital is frozen in a sideways asset, it is capital that isn't attacking other opportunities. Big players love it when retail money is parked at these psychological anchors like $4,720 for gold or $75 for silver. Why? Because it keeps you out of the way while they rotate into the next big growth sector, be it AI, energy, or emerging markets. Look at the CME FedWatch data. The market is pricing in higher for longer interest rates. This is the ultimate headwind for gold. Why hold an asset that pays 0 yield and isn't moving in price when you can get 5% from a government-backed bond? This is the fundamental reason for the struggling momentum we see on the exchanges right now. The $4,720 level isn't just a resistance line on a chart, it's a drain. Every day the price stays here, your economic energy is leaking out. You are being taxed by time. So, if the math is so clearly against us during these sideways periods, why are we so obsessed with these specific numbers? Why do we treat $4,720 for gold or $75 for silver as if they were written in stone? In behavioral economics, this is called the anchoring effect. Our brains are naturally wired to rely too heavily on the first piece of information we receive. When you saw gold hit a high and then settle at $4,720, your brain anchored to that number. Now, every tick above it feels like a victory, and every tick below it feels like a disaster. You've stopped looking at the global macro picture, and you've started obsessing over a digital coordinate on a screen. But let's talk about silver, because the anchor there is even more painful. Silver sitting below $75 is causing a massive amount of psychological distress for investors. Why? Because silver is the restless metal. While gold is seen as a stable store of value, silver is bought for its explosive potential. When gold stays at $4,720, investors are bored. But when silver stays below $75, investors feel betrayed. Think about the narrative. We've been told about the silver shortage, the solar panel demand, and the green energy revolution. All these facts created an anchor in your mind that silver should be at $100 or $150. So when you see it struggling to even hold $75, the gap between your anchored expectation and reality creates a sense of failure. This is the expectation gap. The market makers use these round numbers, $4,720 and $75, as psychological fences. They know that as long as the price stays just below these levels, you will stay in a state of perpetual hope. You think, it's so close to breaking out, I can't leave now. But here's the cold, hard truth. The market doesn't care about your anchors. The MCX doesn't care that you think $75 is cheap for silver. In fact, the longer the price sideways trades below an anchor, the more that anchor transforms from a support level into a ceiling. People who bought in at the top get tired. Every time the price nears $4,720, these tired investors sell just to get out even, creating a wall of selling pressure that prevents the very breakout you're praying for. This is how a sideways market becomes a self-fulfilling prophecy of stagnation. We are literally trapped by our own mental benchmarks. We see $4,720 not as a price, but as a promise that hasn't been kept. And this leads us to a vital question. Is this just a modern phenomenon driven by high
Or is this a recurring cycle that has destroyed the wealth of the impatient for decades? To find the answer, we need to step back from the glowing screens of 2026 and look at the brutal lessons of history. Because history shows us exactly what happens to those who refuse to move when the silence of the market begins to speak. The stagnation we see at $4,720 isn't new. In fact, the most dangerous periods for investors haven't been the sharp crashes, but the dead zones. Take a look at the period between 2011 and 2015. After hitting then record highs, gold didn't just collapse, it entered a grueling 4-year sideways grind. During those years, thousands of retail investors sat on their hands, anchored to the hope of a double top or a moonshot that never came. They watched as the stock market began its historic bull run while their capital sat frozen, rotting in a sideways to lower trend. By the time they finally gave up and sold in 2015, they hadn't just lost money, they had lost 4 years of the greatest wealth-building window in modern history. This is the price of stubborn patience. We saw it again in the 1980s. After the massive inflation-driven spike of 1980, gold entered a silent cycle that lasted nearly 2 decades. Think about that. An entire generation of investors held an asset at a psychological anchor, waiting for a breakout that took 20 years to arrive. In the meantime, the world changed. The internet was born, tech giants rose, and those who were trapped in gold were left in the dust. History teaches us that there are 2 types of people in a sideways market: the holders and the allocators. The holders are driven by ego. They refuse to admit that the anchor has changed. They see $4,720 as a promise. They treat their investment like a religion. But the allocators, they are cold-blooded. They recognize when the economic energy has left a sector. When they see momentum struggling on the MCX and silver failing to breathe life into the $75 level, they don't get emotional. They don't wait for the silence to end. They move their energy to where the noise is, where the growth is. The investors who survived the 2011-2015 trap weren't the ones who joggled through the pain. They were the ones who saw the sideways movement as a signal to diversify, to hedge, or to step out entirely until the trend regained its voice. They understood that in a market of $4,720 gold, doing nothing is actually an active choice to lose purchasing power. So, look at your portfolio right now. Are you an allocator, or are you just a holder waiting for a miracle at a specific coordinate? The silence of the current market is a message. It's telling you that the old rules, the ones that said just buy and hold gold forever, are being tested by a new reality of higher rates and shifting liquidity. We've analyzed the psychology, we've crunched the math of opportunity cost, and we've looked at the wreckage of past cycles. Now the only thing left is to decide how you will respond before the silence turns into a scream. The current stagnation at $4,720 for gold and below $75 for silver is not a safe haven, it is a trial. It's a test designed to filter out those who trade on emotion and reward those who manage risk with cold, clinical precision. Don't let these round numbers lull you into a false sense of security. Being safe in an asset that refuses to move while the world evolves is one of the most expensive mistakes you can make. Remember, in the financial markets, time is either your greatest ally or your most ruthless enemy. When you are anchored to a stagnant price, time is slowly picking your pocket. The lock-in effect is real, but it only has power over you as long as you prioritize the hope of being right over the reality of being profitable. The silence of the market right now is your opportunity to wake up. Reevaluate your position. Ask yourself, am I holding gold because the macro thesis is still valid, or am I just afraid to admit that the momentum has shifted? If gold remains frozen at $4,720 tomorrow, and the day after, and the week after, what is your move? Will you continue to be a holder of a silent promise, or will you become an allocator of new opportunities? I want to hear your strategy. How are you protecting your capital from this silent thief? Are you diversifying, hedging, or standing your ground? Let's talk about it in the comments below. I'll be there to join the discussion. Don't just watch the charts, watch your conviction. Because when the silence finally breaks, only the prepared will survive the noise. Thank you for watching, and I'll see you in the next analysis.